Welcome to Pressure Points. We are previewing Tesla's earnings. That's going to be out after the close on Tuesday, April 23rd. We, of course, got the delivery numbers earlier in the month. I will recap those in a minute, talk about automotive gross margins, and then get to the pressure point, which is the delivery numbers, and specifically delivery expectations. Some changes that will happen with the investor expectations and the street models after they report their quarter for 24, 25, and 26. So it's about really the delivery numbers. Just taking two steps back, of course, Tesla already reported the delivery numbers. They were down 8% year over year. That compared to expectations going into the announcement that they would be up 5%. They grew at 19% in the December quarter. So we've had this kind of slow trajectory downward. And you probably don't need reminding, but it was just 5 quarters ago where Elon was talking about 50% compound growth for a decade. That would mean that you're growing faster in the earlier years, call it 60, 70, 80%. So this has been a remarkable slowdown. A thought on the slowdown, I think what happened is that simply there was a ton of demand pulled forward. And I didn't realize this when it was going on, but I think over the past few years, there were people who had been thinking about getting an electric car, who maybe were caught up in some of the excitement, who typically buy a car once every 5 years. They pulled that forward, bought it in 3 years and 2 years, and now they're good. And I think that the rest of the world is slowly moving towards electrification. I believe that it is better. EVs are better, because of cost of ownership, because of performance. There is debatably an environmental impact on them, but the big picture is I think that they are superior to gas cars. So eventually I think that the tide is going to move in Tesla's favor, and of course they've been doubling down on that future where traditional automotive companies have been slowing their pursuit of that. But I think that is what has happened with the delivery numbers, why they've been so bad. I don't see those bad delivery numbers as a reflection on Elon's brand. Maybe that had a little bit to do with it. But keep in mind, for every person that is turned off by Elon, there's probably someone who is turned on by some of the things that he says. And so kind of think of that generally as a wash. But that's just some context in terms of the delivery numbers. Now, shifting to a couple topics for the call. One is the automotive gross margins ex credits. And normally this would be the pressure point. And it's the pressure point because it is at the battle, at the front line of the battle between, is Tesla a car company or a tech company? A higher margin would support the thesis that this is a tech company and deserves a higher multiple, 7 times revenue, much higher than the current multiple cap longer term. If you believe this is just a car company, then it deserves a much lower multiple. And the best indicator of that would be to look at margins. And those gross margins have been declining over the past year and a half. They peaked right around 29%. It's been generally a steady trend down. In the December 23 quarter, it was 17.2%. That was a slight uptick from September 23, where it's 16.3%. So we saw a little bit of a bump. But in general, that trend has not been Tesla's friend on the gross margin side. Put it into context, traditional auto is just above 10%, so there's still a little bit of advantage that Tesla has, but that gap is closed meaningfully over the past several quarters. And so the reason why this is not the pressure point going into tonight is I think that, or going into their print, is that I think investors are wanting to know just more holistically what's going on with overall demand. And separately is that the street analysts have made some adjustments already about their expectations for gross margin. And this is based on FactSet numbers, but it looks like FactSet is showing that the street is looking for automotive gross margins to decline throughout the year. 15.9% for March, going to 13.5% kind of in the fall, and ending the year right around 15%. As I mentioned, they did 17.2% in the December 23 quarter, so the street's looking for declining margins. For 25, calendar 25, very similar types of margins, ex credits right around that 25%, and for 26, the street is bumped that up to 17%. But the summary here is that when it comes to gross margin, the street's basically saying it's going to take 2.5 years, 3 years to get back to where we were in the December 23 quarter. And so that to me says there's a good dose of conservatism that's been injected into the models. I feel good about where that's at relative to what I think they're going to talk about on their call. The piece that I do not feel good about, and as an investor in Tesla, I am bracing for the stock to go lower after they report their quarter. The piece I do not feel good about is their commentary on deliveries for the balance of the year. And this is the pressure point. We talked about the delivery numbers, and based on the FactSet numbers, the street still hasn't fully adjusted what I think is for the reality of what the business is going to look like in 2024. If you take their reported delivery numbers in March and you grow that 10% sequentially throughout the year, it gets you to about a 6% decline in deliveries in 2024. And the street's currently looking for a 5% increase based on the FactSet numbers. So to me, that says there's about a 10% downward revision that needs to happen in 2024. And most likely, analysts will just kind of roll that through 25 and 26. And so think of the forward revenue numbers more or less coming down by 10% after they report their quarter. I think that's probably going to be viewed as a negative and just continue to beg the question with investors, when are we going to pull out of this funk? I do believe there is a clear case, again, for EVs. I think Tesla embracing this versus what traditional auto has been retreating from, the undeniable of electrification. I think that will bode well for their market share in the future and show a re-acceleration. So I do expect 25 to be up higher than 24 and 26 higher from 25. 26, of course, is where things could get more exciting around the robotaxi, but we'll hold off on talking about that till the 8th of August. So that's the pressure point, is the delivery numbers. Do have a postscript to this episode. A quick thought on that event in August. Undoubtedly, it's going to get some attention on the call. I suspect they will just talk about what they're doing, maybe show some renderings about what they're doing. Keep in mind, in 2019, they talked about robotaxi. Elon said 1 million by the end of 2019 on the road. They did about 1.8 million vehicles in total in 2023. Obviously, to say that didn't happen is an understatement. So investors are probably going to look at a lot of the commentary from Autonomy Day with a little bit of a jaded eye, but I do think that this is a brilliant move to shift to more of a razor blade model. I do expect that autonomy is going to have a breakthrough generative AI type of moment where people don't think it's close, and all of a sudden it gets a lot closer and becomes reality. And we've seen a lot of that with the most improvements in the updates more recently. So I'm optimistic about where that ultimately is going to go. I'm not optimistic about how the stock is going to react going into this print. I hope I'm wrong. I'm not making a hard call on what's going to happen with the stock. I do think numbers do need to come down, though, for the deliveries for 24, 25, and 26. We'll be back after they report. On behalf of Pressure Points, bye for now.